In this video, we're going to talk about Vinco Ventures, trading under the ticker symbol BBIG. Vinco operates in the consumer products and digital marketing sectors. Its most important asset is a social media platform for video streaming in the Indian market. It's definitely one of the more popular platforms in the region, which is expected to fill in the local demand in one of the largest markets. It is both having a good narrative because of the video platform and because it is in the middle of a short squeeze going on between those who want to push the stock lower and those who want to squeeze out the short sellers. The company was founded in 2017 and is based in Pennsylvania. The trading volume of Vinco Ventures has recently been 12.6 million shares compared to an average volume of 14.1 million shares. Over the previous 52-week period, its price has been fluctuating between $1.11 and $12.49. The market cap of Vinco Ventures is currently at $326 million compared to an EV of $137 million. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to BBIG based on its current fundamentals, leverage, and asset composition. Some of the examples of impact by leverage is if the company has a lot of debt, then the market may feel uncertain about the company's capacity to pay back its interest and principals, which in turn may negatively impact its profitability and solvency. Another key element to understand is the asset composition of many companies, and it is especially true for growth-type companies. For many of those companies, one of the most significant assets they own is the goodwill. Goodwill is basically an expectation of the market that the company is able to generate more profit or to have faster growth than other rivals, partially because it may have good management, stronger brand recognition, bigger following online, and so on. So in other words, it's not a tangible asset that companies can use. However, it is often the reason why companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value, including the asset value allocated to the goodwill. Now, in case of BBIG, the market is actually giving a premium to the company despite the fact that there is a short squeeze going on. So in a way, this is a very encouraging news. In comparison to its historical price fluctuations, the stock is 0.42% higher than its 1-month low. Same goes for the 90 days low, and 114% higher than its 52-week low. In terms of the options market, which often gives a hint on the market sentiment on whether the stock price is likely going to head toward, the implied volatility is 1.47 compared to a historical volatility of 0.96. The put-call volume ratio is currently at 0.14, meaning there are a lot more calls options than put options being traded. The most recent volume of options trades has been 43,000 contracts a day compared to the 30-day average of 68,000 a day. In terms of open interest, the most recent volume of open interest has been 905,000 contracts compared to a 30-day average of 922,000 contracts. In terms of its shareholder structure, institutional shareholders hold 13.5% of all outstanding shares. The biggest shareholders include Nomura, Hudson Bay Capital, and Group 1. The relevance of the shareholder structure is important to determine whether you should be holding the stock long-term or to view it more as a short-term volatility play. If the stock is mainly held by retail traders, then this should be a sign that we gotta be careful when trusting our money in this company in the long term. Now, of course, there are a lot of exceptions from what I just said above, but usually the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. Let's also look at the short interest present in the stock, which is the amount of positions that aim to profit if the share price falls lower. Sometimes, if there are significant short interest in total volume, it could be a sign that there is an organized shorting operation going on, like what is going on with GameStop and AMC. And speaking of short squeeze, this is what's going on here as well. The current short interest is 24.7% of the total float, and 55.2% of the dark pool transactions are short positions. Now, let's take a look at the indicators. Financial indicators give us a suggestion of what the price movements are showing, and they can be used as one of the elements to determine what should be our overall approach. Oscillators are showing 1 sell, 7 neutral, and 3 buys, with an overall tendency of buy. The moving averages of the past price actions has been 13 sell, 1 neutral, and 1 buy. The overall tendency from the perspective of moving average is strong sell. The moving average can be used to determine whether the stock is overbought or oversold compared to its previous price fluctuations, which can be used to see if your trade is sufficiently well timed. In terms of pivot points, which are levels of support and resistance sprinkled in the price trends, support levels are $1.23, $2.18, and $2.77. For the resistance levels, they are $3.27, $5.25, and $6.75. Looking at the stock price of Bbig or Vinco Ventures over the past few sessions and weeks, I believe that the share price has been looking to find support after significant downward pressure and volatility over the past few weeks. Market participants are willing to believe that an eventual tide reversal at the end of the short squeeze is possible, and this is why we should never rule out this scenario despite the fact that right now, things are not going in favor of those who want to long the stock. My opinion on the company remains overall worthy of your time to keep it in your watch list, and fundamentally it is a very hard sell to go against a potentially massive volume from retail traders. With that being said, it's fair to say that the market is not providing enough trade volume at the moment for Bbig to go up, but it doesn't mean that things will remain like this forever. We gotta keep in mind that the stock is priced at around $2.50, which is on a support line that has been tested numerous times before, meaning that there is true potential for the trend reversal from here onward. My recommendation is to make sure that your exposure on Vinco Ventures is at a maximum of 0.5 to 1% of your portfolio, but to keep an eye out for any potential support in sight. I would say that the previous peaks over the past few months is a good place to set the initial profit target. In the current market environment, I think that we should be careful about taking positions in the financial market in general, especially when it comes to equity market. Over the past decade or so, the financial market has been living with the help of newly created capital from the quantitative easings, which resulted in the increase of asset prices and the corresponding collapse of their yields. Of course, the low interest rate also contributed to reinforce that phenomenon because the financial sector would first of all see its profit margin squeezed, which will in turn keep the returns of other sectors low as well. At the same time, the market doesn't represent the real economy, and the real economy often doesn't get reflected in the prices of their own securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. And I want to say that fundamentals sometimes doesn't play that much of a role at all. If the asset prices only depend on the fundamentals, then their performances in Northern Hemisphere would have been more than mediocre, because things have mostly been stagnant over the years, ever since the last economic recession. A few things can explain why asset prices managed to remain high during these years, despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their local economies. But because that money is distributed to banks and expected to be loaned to businesses, and that there aren't that many opportunities in the real world. The money went into the financial sector to buy up assets. Of course, the QEs are wrapping up in many countries, so for the next couple of years, it's not going to be the main driving force to keep the asset price high. But it's compensated by the arrival of new capital from different regions in North America because it's still perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be a sustained phenomenon over the years to come. The last phenomenon is the creation of artificial bubbles that are either supported by the real market trends or completely fictional to allow market participants to play the game of hot potato and to either generate profit or to safekeep their capital. Of course, the people who end up with the hot potato lose money, but that's another story. The EV sector in 2020 is an excellent example of this. Nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially in Asia. This means that the market is expected to see its volatility increasing over time, which will provide opportunities to make a profit or to incur losses depending on the timing and risk management of those portfolios. Another thing to note for this period of time is to be very careful with having short positions. Usually, it's already more risky than having long positions because losses are not limited. And with the increased involvement of retail traders, I believe that the stocks being shorted will have a higher probability of getting squeezed, and this will occur randomly, which will result in potentially massive losses. We're also observing very often people will choose to rush in positions not necessarily because the fundamentals are convincing, but because there is a buildup of demand in a specific stock and that people will pile in to ride the gravy train with the rest of us. This kind of behavior is highly risky and may result in heavy losses as well. It's worth pointing out that in 2020 and probably in 2021 as well, the financial market has never presented that many opportunities, but it's also during this period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. The positions should also begin small so that there is an opportunity to average down later. Typically, the growth stocks would take about 5 to 10% in my portfolio overall, and each and every one of them represents maximum 1% of my portfolio. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.